Well, thank you, Russ, for that very sobering introduction to the investment environment. Well, my name's Tony Foster. I'm a Senior Fund Manager at Aberdeen Asset Management, a member of the Diversified Multiasset team. 4 months ago, me and my colleagues were appointed as managers of a fund called the Aberdeen Diversified Income and Growth Trust. It might be known to some of you as BlackRock Income Strategies, or some of you from before that, it was known as British Assets. We were appointed by the board 4 months ago to manage this fund on a strategy that we've been managing at Aberdeen for 2 years, and my co-manager Mike Brooks has been managing for about prior to that for about another 6 years when he was at Baillie Gifford. And my talk tonight is entitled Alternative Asset Classes to Diversify Your Portfolio Income. I think I might change it slightly after listening to Russ and say alternative asset classes to diversify your portfolio, full stop. Because I think our view is that the way to tiptoe through that minefield that Russ portrayed is really to invest in a diverse range of asset classes. And my first slide really highlights some of the characteristics that Russ had talked through. We've got a chart on the left here of bond yields. I started my career in 1988 when gilt yield was around 10%, and today it's at 1.1%. And on the right-hand side, we've got some of the risks facing equity investors, and I haven't even mentioned on there valuation, which was another of the factors that Ross mentioned. So against this background, a balanced portfolio of bonds and equities might struggle particularly to deliver income. So what can you do? How can you invest in a multi-asset approach? Well, we take the view that there are 3 different ways of doing it. There's market timing. Russ alluded to that, trying to buy high and sell low. Buy low and sell high. Buy low and sell high. Market timing, and some multi-asset managers do that. There's hedge fund alpha approach, looking at relative value, trying to buy cheap assets and sell more expensive ones. Or there's the approach that we adopt, which is a simple and transparent approach and one of diversification, trying to find asset classes that have different return drivers that will perform through different stages of that investment cycle that Russ was talking about, and look for asset classes that will perform differently at different times in that cycle, have a broad mix of assets. So what kind of assets am I talking about? On the chart here, they're fairly colourful. We've got equities on the left, including emerging market and private equity. On the right, low returning assets, gold, government bonds, investment grade credit. In the middle, though, there's a wide range of assets now that are available to investors, some through closed-end fund structures, others through more diversified multi-asset funds such as ours. In the 3 columns, we've got higher yielding credit, so corporate bonds or corporate loans, emerging market debt, alternative financing, that might include things such as marketplace lending or aircraft leasing funds, asset-backed securities, structured credit products. These are all higher yielding fixed income, higher yielding credit opportunities that are available to investors. I say some through the closed-end fund structure. In the middle, we have real assets, property and infrastructure, and on the right-hand side, more market-neutral strategies, and a range there, something like insurance-linked securities, again available on through the listed fund structure with companies like Catco or Blue Capital. So there's a large range of assets now that investors can build a portfolio from. If you haven't got a big portfolio, you can invest in a multi-asset fund such as ours to gain a diverse range of exposures and assets to your portfolio. The days of investing everything in a UK equity fund, as many people might have done 10 or 20 years ago, certainly there's less need to do that because of the assets that are available. In terms of our views on the 5-year forecast on the outlook for assets, these figures come from my economic and thematic research colleagues. They produce models on a wide range of asset classes. On the left-hand side, we've got cash and government bonds yielding less than 1%. Up here, yielding about 5%, global equities. And in the middle, some of these assets I was talking about earlier. Emerging market debt, we think looking for returns of around 6% per annum. From here, infrastructure funds, renewable, social infrastructure, some of the credit opportunities I talked about here. So a wide range of asset classes. And in a closed-end fund structure, such as our Diversified Income and Growth Trust, there are a number of assets that have don't have daily liquidity. Money's tied up for longer periods of time, and you can earn higher returns from assets such as private equity funds or property, so infrastructure funds that are developing infrastructure that would be off the top of this chart, but they're available to a closed-end fund investor. So in terms of our fund and what it targets, our target is to deliver a return of LIBOR plus 5.5% net of fees over a rolling 5-year period. And over the last 5 years, the Aberdeen Diversified Growth Open-Ended Fund has delivered just that, around cash plus 5.7, in fact, over the last 5 years. The closed-end, and it has a target of cash plus 4.5%. The closed-end fund, the Diversified Income and Growth Trust, has a higher target because it can invest in assets that you do tie up your money for a longer period and can earn a more attractive return as a result. The portfolio has an attractive yield. The assets that we invest in tend to be yield generating. And at the moment, we've just taken over the fund. The board have decided to cut the dividend from the previous manager, and the current estimate of the dividend would be about 5.2p on a share price of 115, so a yield of about 4.5%. And we think that's entirely sustainable from the portfolio that we are managing. We manage an income fund that delivers exactly that in the open-ended space. And the portfolio, by being diverse, has and historically has delivered a volatility of around half of that of equities, and that's the kind of level that we're targeting in our closed-end fund over a period of time. The key differentiator for us, we believe, is the portfolio is genuinely diversified across a range of asset classes, and I'll show some comparative funds in a second. And compared to our open-ended fund, the closed-end fund can invest in a wider range of Aberdeen's capabilities. We've got colleagues who invest in a number of asset classes that are not available to retail investors because they're institutional funds, whereas the Aberdeen Diversified Income and Growth Trust, being institutional, can invest in those asset classes, and I'll show you how it does that in a second. And so the key, the USP is that for our investment trust is it allows small investors to access the kind of diversified portfolio that the world's largest and most sophisticated investors would hold. So the likes of the Princeton or the Yale endowment funds in the States were founders of the multi-asset approach, and they have very diverse portfolios because they manage a lot of money. If you have a small pot of money, you can invest in a fund like this and get a diverse return. So in terms of the capabilities and the teams that we can call on within Aberdeen, me and my colleagues sit in the middle, the diversified multi-asset team of 6 of us, myself, my co-manager Mike Brooks. We can call on capabilities from all of these investment strategies within Aberdeen. Aberdeen's most known for its equity approach in global and emerging market equities, but we've got a big fixed income team. We've got 218 people managing property assets. I don't know what they all do, but there's 218 of them. We have a quant team that run about £28 billion in active quantitative strategies, and then alternative asset classes in infrastructure, in private equity and hedge funds, and in real assets. And we can call on the capabilities of all these investment teams. Some are spread across the globe, some here in London, some up in Edinburgh, some in Asia, and we can use those capabilities to help build the best and most diversified portfolio for our investors and for the trust shareholders. So as a particular example, this is a fund called the Aberdeen Property Secondary Partners II Fund. We need to really tighten up on some of our names, I think, but this is a property fund that is managed by our team of 18 property multi-manager fund management team. They manage €2 billion, just under €2 billion in property funds, and they invest in and cover over 100 managers and 180 funds. And we can tap into their knowledge base and their specialist expertise to find the best fund the best fund opportunities that they can invest in. And by investing in a wide range of funds, they're often aware of when shareholders and investors in those funds want to sell and have to sell. These are long-dated funds that you can't get your money back straight away. And our team are aware of when there are stakes becoming available. They bought, for example, a Finnish property, a stake in a Finnish retail park very recently on a 30% discount to NAV because there was a distressed seller. They were aware of that and bought it for their one of their funds and made a pretty quick killing. And it was knowing who the manager was, and that the manager had people who wanted to sell. So the investors that wanted to sell, and they bought into that at a very attractive rate. So this fund that we'll be investing in for ADIG will deliver attractive returns by buying into these funds at discounted levels relative to fundamental value. And this fund will target a net return, net of fees of 12%. And its predecessor fund has already delivered well into double-digit returns from following this strategy. And that's the kind of fund that you can't invest in as a retail investor. Technically, I'm not even allowed to tell you about it, which is why it doesn't actually get mentioned here. But it is a fund that we will be investing in through the ADIG fund, because we're an institutional fund to play into. It can then be sold to retail investors. So what does our portfolio look like? This is the illustrative portfolio that we put in a prospectus that was published on the 6th of March, when at the time we were appointed manager. We were appointed by the board, then we had to get a change of investment policy to follow our policy compared to the previous manager, BlackRock. And this was the illustrative portfolio we put in that prospectus. First of all, it's genuinely diversified. The no asset classes make up more than a quarter of the portfolio. We have listed equity in the top right-hand corner, and typically we'd invest somewhere between, in our approach, somewhere between about 20 to 35% or so in equities. It's a key part of a growth portfolio and generates good income, but you don't want it to dominate the portfolio. And our investment in equities is via an actively managed portfolio that's managed on our behalf by the quantitative team, investing in good quality, good value stocks picked on a quantitative basis. And they target an income of 140% of the world equity index yield and 85% of the volatility by picking the best stocks on a quantitative approach. So that delivers a solid chunk of income. Another area where we're getting income is the moment in emerging market bonds. We have a sub-portfolio managed for us by our emerging market debt team. And emerging market debt, Russ talked about the high level of debt to GDP in places like the States and the UK. Many emerging markets actually have debt to GDP figures of less than 100%, and yet you can get a yield of 7% in dollar terms for frontier markets, or 7% in local currency terms, places like Brazil, India, and Russia and the like. And these are markets that, surprisingly, in 2008, if you measure the performance of emerging market debt, not in US dollars, but in a basket of currencies, is the way we approach it, investing using things like the Australian dollar to fund the investment, it actually delivered a positive return in that period when equities went down by nearly 50%. So emerging market bonds is an attractive asset class at the moment from an income perspective and diversification. In the bottom left-hand corner, we've got asset-backed securities and corporate loans, areas that are a floating rate in terms of their interest exposure. As interest rates go up, the interest on these securities will go up, which we think is a key in the current environment. Also, things like, both of them, they have security on the assets that you're investing in. A corporate bond, you're just giving them a company money, unless it's a secured investment, whereas these are secured investments. They're not investment-grade companies, but they're issuing these things, but they're companies issuing against assets. Have infrastructure, many of you be familiar with. We're investing in one or two closed-end funds, but also various funds that include development projects. And we have a range of areas of assets up here in special opportunities. That's things like aircraft leasing, insurance linked I mentioned earlier. We're investing in, just currently getting board permission to invest in a trade finance fund that will deliver double-digit returns from helping fund global trade between importers and exporters, and areas that where banks have sort of withdrawn because of the capital requirements they now have for some of these areas. So there's a really wide range of investments that we can make across a very diverse range of asset classes, using the capabilities of Aberdeen where we have them, and the expertise of the teams, and to help identify third-party managers in some other areas, such as in real assets. We're investing in a farmland fund, a specialist manager in the US that is literally buying farms from farmers who want to retire because their children are now working in Silicon Valley rather than wanting to farm the land, and turning them into things, or better farms in terms of organic produce and the like. And you can earn high double-digit returns from organic blueberries or almonds or all sorts of things in that real asset space. So very attractive return over a period of time. So our approach is one of very much of genuine diversification. We have a very flexible mandate. We can invest widely, but the key thing is the portfolio has to be diversified. And we can show you the returns that we expect from each of these asset classes to give us how they contribute towards our target return. So where does the ADIG, Aberdeen Diversified Income and Growth Trust, fit in against some of its peers? Some of you may be familiar with the likes of RIT Capital or Personal Assets or Rougher, slightly more defensive funds there that have a big slug in cash, government bonds, index-linked gilts, gold and the like. Syncona was formerly known as Beckett, a fund of hedge funds. Each of these has a diverse mix of assets, but in terms of that scheme I produced earlier of equities, the diversifying assets in the middle, shown here in orange, and then low-yielding assets on the right, we're the most diversified by this approach, and more diversified than the fund under the previous manager. Henderson Alternative is predominantly an equity fund investing in emerging market funds. Apart from Henderson Alternative, all of the other funds have traded at premiums to NAV over a period of, over, in some cases, over long periods of time. So we think it's an attractive approach that investors typically do buy into, and it is rated accordingly in the investment trust world. So in terms of the characteristics of the fund, we're taking full advantage of the investment trust structure. It's a closed-end fund, so we don't have to fund redemptions. We can invest in longer dating assets. We do have gearing within the fund. There's a 6.25% debenture, which will help enhance returns in rising markets, and it will, but it is an area that can enhance returns, and it can lead to lower returns if markets fall. But by taking a diverse approach, we're comfortable with the 15% or so gearing within the fund that we've taken on. The fee structure is very competitive. The board were very focused on fees when they appointed us. The fee is at 50 basis points, 0.5% per annum for a very wide-ranging portfolio, 0.5% on the first 300 million of assets and 0.45% on higher assets than that. And it's very competitive for such a wide range. The total expense ratio is 0.7% for the fund, and there are some third-party fund costs of around 50 basis points, so 1.2% all in its sort of TER, old money as it were. The board have introduced a discount control policy, the buyback shares at a 5% discount to NAV, and they've also introduced a continuation vote in 2020, so there's a chance to get your money back if the approach that we think and are convinced will be popular proves not to be, then there is a chance to have a continuation vote. And finally, it benefits from Aberdeen's investment trust marketing capabilities. The fund has its own website, which I failed to put on here, but it's aberdeendiversified.co.uk, where you can access a lot more information on the fund. So in terms of summing up, the Aberdeen Diversified Income and Growth Trust follows a genuinely diversified multi-asset portfolio approach that will deliver, we will target attractive long-term returns, LIBOR plus 5.5% over 5 years, delivering a healthy and reliable income from a wide range of asset classes, many of which are naturally income generative, and has historically this approach has shown much lower volatility, typically around half that of equity markets. So, for example, last February, when the global equities fell by about 12%, our open-ended fund fell by around 4% over that period. So, much lower drawdown in periods of market weakness. And the key differentiator for our closed-end fund compared to our open-ended fund is that we are harnessing all of Aberdeen's substantial breadth and depth of resources in those those alternative asset classes that can deliver attractive income and can help you tiptoe through that minefield that Russ portrayed earlier. And ultimately, it allows all investors, no matter how big or small their investment, to invest in the kind of diversified portfolio that the world's largest and most sophisticated investors might hold. So thank you very much, and thank you for your attention. I'll be delighted to take any questions and contribute to the panel later on. Thank you.